$7,500 a year into a Roth IRA. That's the limit most people know. But if your 401k allows it, there's a door that opens. Up to $47,500 a year into a Roth account. Most people don't even realize their plan already has this feature. In this video, I'm covering 4 things. 1. What the Mega Backdoor Roth actually is. 2. What conditions you need to meet to use it. 3. How it works step by step. 4. Most importantly, is this actually right for you? If you watched the last video, we covered the Backdoor Roth IRA. How high earners can get around the Roth IRA income limits and contribute $7,500 a year, or $8,600 if you're 50 or older. And we hammered this home. The Backdoor Roth IRA is capped at the IRA limit, $7,500, period. So if you've already maxed that out and you want to save even more, that's where the Mega Backdoor Roth comes in. What is the Mega Backdoor Roth? Here's the core idea in one sentence. Use your employer retirement plan, usually a 401k, to make after-tax contributions above the regular limits. Then convert that money into a Roth account. Why Mega? 3 things from this table. 1. Backdoor has no legal income limit. It's just used by high earners. 2. $47,500 is the theoretical max. Employer match eats into it. 3. Mega is not affected by pro rata. That's the biggest difference between the two. Here's the biggest catch, and I can't emphasize this enough. A lot of people get fixated on the $47,500 number, but they miss the most important question. Does your 401k plan document actually allow this? According to the IRS and multiple plan providers, to use the Mega Backdoor Roth, your 401k plan must allow both of these. 1. After-tax contributions. This is a separate bucket from pre-tax or Roth contributions. 2. In-service distributions or in-plan Roth conversions. This is how you get the money into a Roth account. Without both of these, none of the numbers matter. It's the entry ticket. One more thing. Some plans put an age restriction on in-service distributions to an external Roth IRA, often 59 and a half. In-plan Roth conversions usually don't have that age limit. Check with your plan administrator. All right, let's look at the 2026 numbers. The total 401k limit is $72,000. That's the IRS cap on everything that can go into your 401k from every source. You, your employer, all of it. It breaks down into 3 parts. First, your regular deferrals. The money you choose to put in. For those under 50, that's capped at $24,500. Older savers qualify for catch-up contributions. Second, your employer match. And third, after-tax contributions. That's the Mega Backdoor piece. Whatever's left after you subtract your deferrals and your employer match, that leftover is your Mega Backdoor room. So the rule is simple. The more your employer matches, the less space you have for the Mega Backdoor. Quick important note, catch-up contributions do not increase your Mega Backdoor room, even if you're over 50. That after-tax space is still capped at $47,500. The catch-ups are completely separate. Here's the math. After-tax room equals total limit minus your deferrals minus employer match. With 0 employer match, no matter your age, $47,500 is the ceiling. That's the theoretical maximum. You can't put in more than that for Mega. The catch-ups don't expand this bucket. How it actually works. Let's use Sarah as an example. She's 35, making $200K a year, and she wants to do the Mega Backdoor. Step 1. Max out her regular 401k deferrals. She puts in the full $24,500. Pre-tax or Roth, doesn't matter. She just fills that bucket first. Step 2. Check her employer match. Her company matches 4% of her salary. That's $8,000. Step 3. Do the math. $72,000 total limit, minus her $24,500, minus the $8,000 match. That leaves $39,500. So she can put $39,500 into her 401k as after-tax money this year. Step 4. Convert it to Roth. She can do an in-plan conversion to a Roth 401k, or she can roll it out to a Roth IRA. Either way, that $39,500 lands in a Roth account, and from that point on, it grows tax-free. Now this is critical, and I want to make sure you don't miss it. That $8,000 employer match, that's employer money. It cannot be converted to Roth. It's always pre-tax, and it stays pre-tax. The Mega Backdoor only works with your after-tax contributions, not your employer's money. So when you see that $72,000 total in Sarah's example, that's the 415C total limit. That's the maximum amount that can go into her 401k from all sources combined. It's not the amount that goes into Roth. Only the after-tax piece, the $39,500 in Sarah's case, actually makes it into the Roth account. Everything else stays where it is. The Mega Backdoor Roth is powerful, but there are 3 traps you need to watch out for. Now here's the first trap you need to watch out for. Any earnings that grow on your after-tax contributions before you convert them, those earnings are taxable as ordinary income in the year you convert. And here's the key distinction. Your principal is never taxed. Only the growth that happens before conversion gets taxed. So here's the fix. Convert as soon as possible. Ideally, the same day you contribute. That way, there's little to no earnings to worry about. Now, here's a pro tip. If you do have earnings before conversion, there's a strategy you can use. It's called a split rollover. Under IRS, Notice 2014-54. You can send the after-tax principal to a Roth IRA and the earnings to a traditional IRA. That way, you defer the tax on the earnings instead of paying it right away. But, and this is important, this only works with a direct rollover. If you take a check first, the 60-day rollover rule breaks the split option. And not all plan providers even support this. So check with your administrator before you try it. That said, converting immediately is still the simplest and lowest tax option. You can't beat just doing it right away. Trap 2. Starting in 2026, the Roth catch-up mandate kicks in for high earners. Here's the rule. Under Secure 2.0, if your FICA wages from the prior year are over $150,000 and you're 50 or older, your catch-up contributions must go to a Roth account. No more pre-tax option. But the qualification is more specific than you might think. It's based on FICA wages from the same employer in the prior year. That's W-2 Box 3 money. So investment income doesn't count. Money from a second job doesn't count. It's only what that specific employer paid you. This is where freelancers or people with multiple jobs often get confused and think they qualify when they might not, or think they don't qualify when they actually do. So double check which employer's wages you're looking at. Trap 3. The 5-year rule. This one trips people up all the time. A lot of people think Roth is Roth, but regular Roth and Mega Roth have different rules. IRS rules require Roth IRA withdrawals to follow a strict order. You must fully exhaust Layer 1 first, then Layer 2, and only then Layer 3. Layer 1. Regular Roth IRA contributions. Withdraw anytime, tax-free and penalty-free. Layer 2. All conversion principal, whether from Backdoor or Mega, is conversion money. Each conversion has its own 5-year clock. If you withdraw before 59.5 and within 5 years of the conversion, the 10% penalty applies. No income tax, just the penalty. Layer 3. Investment earnings. Must satisfy both 5 years and 59.5 to be completely tax-free and penalty-free. Otherwise, income tax plus 10% penalty apply. Critical rule. You cannot skip Layer 1 to access Layer 2 or Layer 3. The funds must be consumed in order. If you do multiple mega conversions, each one has its own 5-year clock. A 2026 conversion unlocks in 2031. A 2027 conversion unlocks in 2032. You have to track each one separately. You can't mix them up. Now, the most important question, does this strategy actually fit you? Here's who it fits. First, you've already maxed out your Roth IRA or Backdoor Roth IRA. That's the prerequisite. Second, your 401k plan allows after-tax contributions and in-service distributions or in-plan Roth conversions. That's the hard requirement. Third, you have the cash flow to put away extra money beyond the regular limits. Fourth, you're planning to stay at your current job for a few years. Some plans restrict conversions before you leave. And fifth, you understand the 5-year rule and you're okay with it. Now, who should skip it? If your 401k doesn't allow after-tax contributions and conversions, skip it. It's a non-starter. If you haven't maxed out your regular 401k yet, don't even think about Mega. Fill the regular bucket first. If your employer match eats up most of your $72,000 room, your Mega space is too small to bother with. If you don't have the cash flow, don't force it. If you're leaving your job within 3 years, the timing might not work out. And if you don't want to deal with the 5-year rule complexity, that's totally fine. It's not for everyone. Let's quickly compare the 3 Roth strategies. Quick note, the Roth IRA limits I'm about to mention are for those under 50. That's $7,500. If you're 50 or older, you get an extra $1,100 catch-up, which brings your total to $8,600. For the Mega Backdoor, the $47,500 cap applies regardless of age. Catch-up contributions do not expand that space. All right, let's jump into the 3 strategies. First, direct Roth IRA contributions. For people with income under the limit, in 2026, that's $168,000 for single filers, $252,000 for married filing jointly. You can contribute $7,500 directly. Principal is always free. No 5-year rule. But investment earnings require both 5 years and age 59.5 to be tax-free and penalty-free. Key condition: income within the limit. Second, Backdoor Roth IRA. For high earners who can't contribute directly, contribute to a traditional IRA first. Then convert to Roth. Same $7,500 limit. Conversion principal IS subject to the 5-year rule. Each conversion has its own clock. Withdraw before 59.5 and within 5 years, 10% penalty. Earnings also require 5 years plus 59.5. Key condition: if you have pre-tax traditional IRA balances, pro rata taxation applies. You need to clear them or roll into a 401k first. Third, Mega Backdoor Roth. For people who want to save more, your 59.5 must allow both after-tax contributions and in-service distributions or in-plan Roth conversions. In 2026, the theoretical max is $47,500. But your actual room gets reduced by employer match and your own Roth contributions. Conversion principal has its own 5-year clock per conversion. Earnings require 5 years plus 59.5. Key condition: 59.5 allows after-tax contributions plus in-service distribution or in-plan Roth conversion. Bottom line, income under the limit. Direct Roth IRA, $7,500. Principal is always free. Income over the limit. Backdoor Roth IRA, $7,500. Conversion principal has a 5-year clock per conversion. Want to save more? Check if your 401k supports Mega. Up to $47,500. Same 5-year clock per conversion. Earnings reminder. For all 3 strategies, investment earnings require both 5 years and age 59.5 to be completely tax-free and penalty-free. A few practical things before you go. First, order of operations. The IRS doesn't really care what order you do things in. Your limit is your 415C cap, but in practice, filling your regular deferrals first is how most people do it. It's the standard approach. Second, talk to your plan administrator. Call them and ask 3 simple questions. Does my plan allow after-tax contributions? Does it allow in-plan Roth conversions? And if in-service distributions are allowed, is there a 59.5 age limit? Get those answers first. Third, ACP testing. This is a hidden risk. After-tax contributions are subject to ACP non-discrimination testing. If the plan fails, HCEs, highly compensated employees, could have their excess contributions returned with earnings, and the whole amount becomes taxable. Even safe harbor plans aren't exempt from this. So ask HR if the plan has ever had to refund money. Most employees won't be affected, though. Fourth, policy risk. Congress has tried to shut the Mega Backdoor before. It's still here for now, but it could change. So don't treat it as a forever guarantee. Use it while it's available, but stay informed. The Mega Backdoor Roth is the biggest cap strategy in this series. If you qualify, it might be the most money you can legally put into a Roth account each year. If you don't qualify, at least you know it exists and why it doesn't fit you. Next episode, we're covering 401k rollover. What happens to your 401k money when you change jobs? Drop a comment below. Does your 401k plan allow after-tax contributions? Have you considered the Mega Backdoor Roth?